What's up, investors? Iggy the Investing Iguana here, and boy, do I have an exciting video for you today. If you're looking to diversify your portfolio and capitalize on the travel industry's resurgence, you won't want to miss this. In this video, I'll be diving deep into the world of hospitality REITs, or real estate investment trusts focused on hotels, resorts, and other accommodation properties. These bad boys have been absolutely crushing it lately, with an average distribution per unit growth of a whopping 21% in the financial year 2023. That's right, folks, a 21% increase in payouts to investors like you and me. So, whether you're a seasoned pro or just dipping your toes into the world of REITs, this video is a must-watch. I'll break down the performance of the major hospitality REITs in Singapore, including ARA US Hospitality Trust, CapitaLand Ascott Trust, CDL Hospitality Trusts, Far East Hospitality Trust, and Frasers Hospitality Trust. We'll explore the factors driving their success, the challenges they faced, and what the future might hold for this sizzling hot sector. Get ready to take notes, because by the end of this video, you'll have a solid understanding of why hospitality REITs are back in a big way and how you can potentially profit from their impressive growth. On average, the 5 major hospitality trusts in Singapore, ARA US Hospitality Trust, ARA H Trust, CapitaLand Ascott Trust, Class, CDL Hospitality Trusts, CDLHT, Far East Hospitality Trust, FEHT, and Frasers Hospitality Trust, FHT, reported a whopping 21% increase in their DPU for FY 2023. That's a pretty impressive number, and it's largely due to the strong recovery in international travel after the pandemic. Let's take a closer look at some of these trusts and their performance. ARA US Hospitality Trust, also known as ARA H Trust, is a company that specializes in the management of properties across the United States. In the fiscal year of 2023, the company experienced a significant increase in its distribution per stapled security, DPS, a key performance indicator in the real estate industry. This increase, which amounted to 12.3%, was a result of several factors. Firstly, the company saw an improvement in its revenues. This could be attributed to a variety of reasons such as strategic business decisions, favorable market conditions, or increased demand for their properties. Regardless of the specific reasons, this increase in revenue played a crucial role in boosting the company's DPS. Secondly, ARA H Trust demonstrated robust operational performance throughout the year. This implies that the company's management and operational strategies were effective, leading to increased efficiency and profitability. Operational performance is a broad term that can encompass various aspects of a company's operations, including but not limited to cost management, resource allocation, and customer service. Another noteworthy achievement for ARA H Trust in FY 2023 was the improvement in their portfolio occupancy rate. While it was still below the levels seen before the pandemic, the occupancy rate improved by 4 percentage points year-on-year, reaching 69.3%. This is a positive sign, indicating that the company is recovering from the impacts of the pandemic and is moving in the right direction. The occupancy rate is a crucial metric in the real estate industry as it directly impacts revenue. A higher occupancy rate means more income from rent, which contributes to the overall financial health of the company. CapitaLand Ascott Trust, also known as Class, holds a prominent position among the larger hospitality trusts in Singapore. In the fiscal year of 2023, Class reported a significant increase in its distribution per share, DPS, which rose by 16% compared to the previous year. This notable growth can be attributed to several key factors. Firstly, Class made strategic acquisitions during this period, which contributed positively to its overall performance. These new assets added to the trust's portfolio not only diversified its income sources but also enhanced its potential for future growth. Secondly, Class benefited from a stronger operating performance. This was largely due to the recovery of international travel, which had been severely impacted by the global pandemic. As travel restrictions eased and tourism activities resumed, the hospitality industry began to rebound. This recovery trend was reflected in Class's improved operational results. In fact, an important metric in the hospitality industry, the revenue per available unit, RevPAU, reached 103% of pre-pandemic levels in the second half of 2023 for Class. This figure is quite impressive, considering the severe downturn the industry faced during the pandemic. It demonstrates the resilience of the hospitality industry and its ability to bounce back from adverse situations. CDL Hospitality Trusts, commonly known as CDLHT, is a significant entity in the hospitality trust sector. For the fiscal year 2023, CDLHT announced a distribution per share, DPS, of 5.70 Singapore cents. This figure represents a modest increase of 1.2% compared to the previous year, indicating a steady growth trajectory for the trust. The growth in DPS was underpinned by an improvement in their net property income, which saw an increase of 11.8%. This improvement can be attributed to a variety of factors, including efficient management, strategic investments, and favorable market conditions. However, it's important to note that the growth in DPS was somewhat offset by higher interest expenses. These expenses are often associated with loans or debts incurred by the trust, and they can impact the overall profitability. Despite these challenges, CDLHT managed to achieve a significant milestone. They recorded the highest ever full-year revenue per available room, RevPAR, for 5 of their hotels located in Singapore, Japan, the UK, and Italy. RevPAR is a key performance metric in the hospitality industry as it measures the average revenue generated per available room. This achievement is a testament to the strong demand for their properties and the successful strategies implemented by the trust. Far East Hospitality Trust, also known as FEHT, is a key player in the hospitality trust sector. In the fiscal year of 2023, FEHT reported a substantial increase in its distribution per share, DPS, which grew by an impressive 25.1%. This growth rate surpassed its DPS in FY 2019, before the global pandemic disrupted the hospitality industry. This significant growth indicates a strong recovery and a positive trend for FEHT. The growth in DPS can be attributed to several factors. Firstly, the trust's hotel portfolio saw a remarkable increase in its revenue per available room, RevPAR, a key performance metric in the hospitality industry. The RevPAR increased by 47.8% year-on-year, indicating a strong demand for their hotel rooms and a successful recovery from the downturn caused by the pandemic. Secondly, FET's serviced residence portfolio also reported positive growth. The revenue per available unit, RevPAU, another important performance metric, increased by 17% year-on-year. This growth suggests that their serviced residences were highly sought after, contributing to the overall profitability of the trust. The substantial growth in both RevPAR and RevPAU demonstrates the pent-up demand for travel and accommodation. With the easing of travel restrictions and the return of tourism activities, there was a surge in demand for hotel rooms and serviced residences. This pent-up demand translated into higher revenues for FEHT, leading to the impressive growth in its DPS. Frasers Hospitality Trust, also known as FHT, is a significant player in the hospitality trust sector. In November 2023, FHT reported its financial results for the fiscal year 2023, which ended on September 30, 2023. One of the key highlights of their financial performance was the substantial growth in their distribution per share, DPS, which increased by a remarkable 49.3% compared to the previous year. This impressive growth in DPS can be attributed to several factors. Firstly, the global tourism industry experienced a sustained recovery during this period. After the severe downturn caused by the global pandemic, travel restrictions began to ease, and tourism activities gradually resumed. This recovery in global tourism had a positive impact on FHT's operations, contributing to their strong financial performance. Secondly, FHT benefited from an improved operating environment. With the easing of travel restrictions and the return of tourism activities, the demand for hotel rooms and serviced residences increased. This increased demand led to higher occupancy rates and revenues for FHT, further boosting their financial performance. In their latest business update for Q1 FY 2024, FHT noted that the revenue per available room, RevPAR, for all their country portfolios increased year-on-year, with the exception of Singapore and the UK. RevPAR is a key performance metric in the hospitality industry, as it measures the average revenue generated per available room. The increase in RevPAR indicates a strong demand for their properties and a successful recovery from the downturn caused by the pandemic. However, the RevPAR for their properties in Singapore and the UK did not increase as expected. According to FHT, this was because the pent-up travel demand in these markets had already been satisfied. This suggests that the initial surge in demand for travel and accommodation after the easing of travel restrictions has started to normalize in these markets. Now, while these hospitality trusts saw strong operational performance, it was partially offset by higher interest expenses. However, most of them were prudent in their capital management, and their gearing ratios, the amount of debt they have relative to their assets, remained relatively stable. On average, the cost of borrowings for these 5 trusts grew by 80 basis points, that's 0.8 percentage points, between December 31, 2022 and December 31, 2023. However, their average gearing ratio rose only marginally, from 36.2% as of December 31, 2022, to 36.4% as of December 31, 2023. That's a pretty modest increase, and it shows that these trusts were able to manage their debt levels effectively. In fact, Class, FEHT, and FHT even saw their gearing ratios dip by 0.1%, 0.7%, and 0.7%, respectively, during that period. That's a good sign, as it means they were able to reduce their debt levels relative to their assets. So, what does all this mean for investors? Well, it's clear that the hospitality industry has made a strong comeback after the pandemic, and these trusts have been able to capitalize on that recovery. Their strong operational performance and prudent capital management have allowed them to increase their payouts to investors, which is always a good thing. Of course, there are still risks to consider, such as the potential for a global recession or another pandemic-like event that could disrupt travel and tourism. But for now, it seems like these hospitality trusts are well positioned to continue delivering solid returns to their investors. As always, it's important to do your own research and invest according to your risk tolerance and investment goals. But if you're looking for exposure to the hospitality industry and the potential for steady income streams, these hospitality trusts might be worth considering. All right, folks, we've covered a lot of ground today, from the impressive 21% distribution per unit growth of hospitality REITs in FY 2023 to the individual performances of the major players in Singapore. I hope you've gained valuable insights into this exciting sector and its potential for generating passive income. Now, it's time for you to take action. If you're convinced that hospitality REITs are a smart addition to your portfolio, do your due diligence, research the specific trusts that pique your interest, and consider investing. Remember, diversification is key, and these REITs could be a great way to gain exposure to the travel industry's recovery. If you found this video informative and valuable, do me a solid and smash that like button. It really helps me out and lets me know that you're enjoying the content. And while you're at it, hit that subscribe button and turn on notifications so you never miss an update from your favorite finance-savvy reptile. I'll be back soon with more